Awesome. All right. Okay, so today we're going to talk about financial projections and accounting. Here's an overview of what we'll be talking about. We're going to be talking about categorizing costs. Okay, so when you start a business, always think about what your costs are because there are three things. You have your revenue, your costs, and your profit. And when I teach managerial accounting, I tell everybody that costs are so important because if you know how much something costs to make, then you can figure out what your selling price has to be. If you know what your selling price has to be, you can figure out how many units you'll sell. Obviously, the higher the price, the less you'll sell. The lower the price, the more you can sell. So if you know your costs, you can figure out how much revenue you can expect to make, and that will help you to figure out how much profit you're going to generate. Okay, so we'll talk about the fact that costs can be variable or fixed in nature. So we'll give some examples of variable and fixed. Also, we'll talk about setting a selling price. Okay, so when you go and you buy something and it's $19.99, why is it $19.99 and not $20, right? Where do they get that number from, $19.99, right?
See, it sounds better.
It definitely sounds better. It sounds like it's cheaper, but it's only 1 cent cheaper, right? So when you're doing your presentation, the judges are going to ask you about your numbers. Okay, so typically, a rule of thumb is the bigger the number you have, the more of an explanation you have to be able to provide. Okay, so I'll talk to you about how to figure out what the costs are, how to figure out your selling price, and how to have your story or explanation for the judges. One thing that we're going to talk about when we discuss costs and selling price is this notion of break even. Okay, so I have a story for you. I was at the haircuttery getting my hair cut, and I was talking about accounting. So the person that cuts my hair is also the manager of the location, and she was saying, "Oh, what are you teaching in school right now?" And I said, "Oh, I'm teaching break even." And then her eyes lit up, and she said, "Oh my gosh, the break even for our business is $30,000 a month." Okay, so she knew exactly how much she had to make in order to break even, which means you don't have a profit, but you don't have a loss. Break even is super important because that's the point where if you cross over, you start making money, and if you don't do your break even point, then you're going to be losing money. Okay, so all of this is so that you can present to potential investors. Okay, and then we'll have an activity that we'll do at the end of the presentation where you can start thinking about variable, fixed costs, and then also your selling price. Okay, all right, so let's talk about costs. First, we have something called a variable cost. Okay, so variable costs are typically the same per unit. Okay, and I'll give you a real-life example. Let's say that I'm going to brew kombucha out of my house. Okay, so kombucha is like a fermented tea. Okay, so I actually have a friend who does that. I was over her house, and she had this, it looked like it was in a glass jar, and it looked like there was mold on top. But it was actually kombucha. And if you brew kombucha and have your own kombucha tea company, a variable cost is something that is going to be the same per unit. It increases in total as the units sold increase. So look at this graph here. If you sell 0 units, how much variable cost do you have?
0.
0. As you start selling more units, in this case we have computers, as you sell more units, your costs start to go up, right? So the more units you sell, the more cost you have. The less you sell, the less you have. With the kombucha example, how about glass bottles? That's a variable cost. Let's say that you pay 50 cents per glass bottle. That's your cost, right? So if I sell 0 units, I have how much bottle cost? 0. If I sell 2 units, then I have $1 in bottling cost. Okay, so variable costs are important to think about. When you're going to start a business, think about what your variable costs might be. Can somebody give me another example of a variable cost for a business? What do you think? Yes.
Buying t-shirts?
T-shirts, yeah, t-shirts could be definitely a variable cost because the more, are you talking about selling t-shirts?
Yeah, selling t-shirts. So like we have to buy them from the manufacturer. Right. We're going to buy however many, 20, 50, 100. And if, we sell them, then obviously we made money off of them. If we don't sell, then that's just cost that's sitting there and not doing anything.
Right, exactly. So a t-shirt would be an excellent example for a company that's selling a product where you have like a logo on it or you have a design on a t-shirt. The more shirts you buy and sell, the more your cost is going to be. That's going to be a variable cost. Okay, so you have variable costs and you also have fixed costs. So fixed costs are constant in total. It means it's always the same. Right? It decreases per unit sold. It decreases as units sold increase. So fixed cost here is a straight line. So if you sell 0 units, how much is your fixed cost? In this case, it's $10,000. If you sell 6,000 computers, then your fixed cost is still $10,000. Right, so fixed cost is always the same amount. Typically, we say that fixed costs are per time interval, like per month. So for example, if I have a kombucha tea company, then my rent would be a fixed cost. Because let's say I pay $1,000 a month in rent. If I produce 0 units, then I have $1,000 per month in rent I have to pay. If I make 50 units, I still have $1,000 in rent that I have to pay. Right? So I think this part is confusing. It says that it decreases per unit as units sold increase. Okay, that means, let's say my fixed cost is $10,000. If I sell 1 unit, how much is my cost per unit? Okay, what's 10,000 divided by 1? 10,000. If I have $10,000 in fixed cost and I sell 10,000 units, what's my fixed cost per unit?
$1.
It's $1, right. So fixed costs are always the same, but the more you make, the more efficient you can be in terms of dealing with your fixed costs. Okay.
Like a website.
A website, exactly. So you pay somebody to be the webmaster for your website, and you pay a certain amount every month. The more people you have, the more traffic you have coming to your website and using the website, the more efficient you are and the more you're utilizing your resources. Okay, so a mixed cost is just variable and fixed together. So think about variable as being per unit and fixed as being like per month, right, per unit of time. Here's the fixed cost line because it's straight, and then this is the variable cost component. It's going to be a line that's going up. But you see that this red line here is your fixed and variable together. It's called a mixed cost. Because in real life, companies have mixed costs. They have variable costs and fixed costs together. Okay, so we talked about variable cost and fixed cost. We also need to talk about your selling price. Selling price should be based on cost. Obviously, the more expensive it is to make something, the higher your selling price has to be, right? Because if your selling price is not going to exceed your cost, then you can't make any profit. Right? A good way to figure out what your selling price should be is to see what competitors do. Right? So look at other products that are approximately the same as what your product is, and then figure out how much they're charging. Right? One of the questions that the judges always ask you at the competition is, how did you set your selling price? Right? And so if you say, well, it just sounded like a good selling price, well, that's not a good explanation for how you set your selling price. You should look at what your competitors are doing, and then think about what your strategy is going to be also. Right? So price penetrating, that in accounting is the notion that you set your selling price a little bit lower and you accept less profit. And why would you do that? What's that?
I was going to say to stay competitive.
To stay competitive, right. So I have to have a strategy here. Let's say that I'm going to set my selling price just above my cost. And so that way it'll be cheaper for the customer to buy my product, and it means I can sell more, right? So that's one strategy. So you can accept less profit per unit, but just sell a lot more units, right? Or you can price skim. That's the notion that you're going to set your selling price higher, and then that means every time you sell a unit, you make a lot of money, right? So if you do that, you're probably not going to sell as many units, but each time you do sell a unit, you'll be making more profit, right? So which one is better? Is it better to do more volume and make less profit, or is it better to do less volume and make a lot more on each unit you sell? It's hard to say,
Depending on what.
right? It depends on the market. And a lot of this is really trial and error also. Okay. Also, be creative about selling prices. Okay, so going back to the $19.99 example, right? It's basically $20, right? So why do they charge $19.99? Because
Sounds cheap.
it sounds like it's cheaper, right? So that's a marketing strategy. Right? And another consideration about selling price is to charge people what they're willing to pay, right? Okay, so I'll give you a story that talks about charging people what they're willing to pay. So many years ago, there was the Concorde, which actually would take you from like New York to London in less time than it normally would take if you took a regular airplane. The Concorde was a supersonic aircraft. And has anybody seen pictures of the Concorde? It has the swept-back wings, and it has a very narrow fuselage and like a pointy nose in the front. And for many years, actually, the airline was not very profitable. And overall, it was not a very profitable project. But flying on the Concorde actually was very expensive because what British Airways did was they actually did a survey and they asked people, how much are you willing to pay to fly supersonic across the Atlantic if we provide good food and a comfortable seat? And they realized that people were willing to pay a lot more than they expected. Right? So a lot of times you can charge what people are willing to pay. Mr. Lang actually brought in a whole box of these marshmallow cookies that were covered in chocolate. And he said, you can have one as long as you fill out this questionnaire. It's a one-question survey. And the question was, how much would you pay for this if you had to buy it? So he was actually doing some market research for somebody and trying to figure out what people are willing to pay for the product that he was selling. So figure out what people are willing to pay. Is there any way to get people to pay more for something? To change people's perceptions?
Incentive.
Yeah.
Provide some incentives, or if
If it's rare.
if it's rare, they're willing to pay more, but it might cost you more. What's a way to get people to pay more for something without incurring more cost on my side of things? Yes, Molly.
Well, for example, what like the brand stands for.
Right. So branding is a very good way to get people to pay a little bit more for something. Or if you're going to give some money to charity, every chocolate cookie we sell, we will donate a certain portion to charity. So you can be very creative in terms of figuring out a selling price that is going to be a little bit higher based on how you market your product to the customer. Okay, so now that you have variable cost, fixed cost, and your selling price, break even is very important. So here's a graph here. Okay, so just know that this yellow line is your sales revenue line. Okay, so if you don't sell anything, guess how much money I make? How much revenue do I have? Zero, right. So the more units I start to sell, the more my sales revenue, the more the yellow line goes up. This red line is your cost line. Okay, so you can see if I don't sell anything, how much cost do I have? $200,000. That's because of the fixed cost, right? As you start to sell more units, you can see your cost starts to go up, right? Because of your variable cost. At some point, these two lines cross over and they intersect, right? At 1,000 units of activity, at $500,000, these two lines intersect, and that's called your break even. That's where you don't make any money, but you don't lose any money. Look at what happens if you're to the left of the break even. If you're to the left of this line, the intersection of those two things, you can see that the red line, the cost line, is higher than the revenue line. This is where you lose money. If you can sell more than the break even, then you can see that the yellow line, the revenue line, is higher than the cost line because you are generating a profit. So in your financial projections, you have to figure out what is the break-even point. Because if you're below the break-even point, you're losing money. Once you can hit the break-even and sell more than that, you're making a profit. Yes, sir?
Does the break-even point include the salaries of your employees and stuff like that?
It could. Depends. Are salaries variable or are they fixed? So if they're fixed, of course it's going to affect break-even. If it's variable, it also affects it too. Okay, so I'm glad you asked that question because I have one formula I want to give you. Okay, and I'm going to write it down here. Okay, so to figure out your break-even in units, what you have to do is you have to take your fixed cost divided by your selling price per unit minus your variable cost per unit. That will give you your break even in units. So does salary affect break even? Of course it does, because it's a cost. But then the question is it a fixed cost or a variable cost? Okay, so let's do an example here. Let's say that my fixed cost is $5,000. And what's my selling price? Give me an easy number, like. Okay, so we'll say 10. Make the math easy. It's $10. Minus, what's my variable cost per unit?
Say $1.
Okay, so that means this is a very profitable product, right? Because it looks like you're making a lot of profit on each unit sold. Can somebody tell me the break even in units? It's 5,000 divided by 9, which is
450.
okay. So it's not a whole number, right? It's
555,
okay. 555.55, right? Okay, you can't make 0.5 of anything, right? Maybe if you sell a pair of shoes, you could sell somebody one shoe. Right? So it's actually 556 units. That's my break even. What happens if I sell less than 556 units? I'm losing money. If I sell 556 units, I am making exactly $0 profit. I'm not making money, I'm not losing money. If I can sell more than 556 units, I am generating a profit, right? Okay, so finally, let's talk about,
Professor Vick,
yes,
I have a quick question.
sure.
So if you're selling, for example, like a gym membership, and where they're going to pay every month, or just any membership,
Mhm.
do you calculate like the first their first initial purchase, or do you do for like a whole year? Or?
Typically, you can do it for a time interval like up to a year. So you could say for a year, and if they're paying every month, so that means that it's basically the same customer, but they're paying over and over again. So you can say that the number of units sold is like 12 units per year, because you have one customer and they're paying every single month. So it's like every month they're buying another unit, like another unit of membership. Right? So think of things in terms of like units, how many units you sell. Right? Okay, so I have a question for you. When you present to the investors that you're going to be presenting to, in other words, the investors are the judges, right? What are some things that you're going to talk about? Well, you're going to do a couple things. You're going to try to keep things simple. Okay, so the more complicated something is, the harder it is for somebody to kind of look at it and say, oh, I kind of understand the basic idea of what you're trying to say. Right? Make sure that when you present to the judges, it's a good idea to use an Excel spreadsheet if you know how to, okay, and then I can help you with that. So in an Excel spreadsheet, it's good because you can just use formulas, and you can say, okay, here's my selling price times, this is how many units I expect to sell. These are my variable costs, my fixed costs, so this is my profit. The Excel spreadsheet will do everything for you in terms of the math. And then you can say, okay, the next month I think my sales will go up by 10%. I think my variable costs are going to go up by 10% also. And then you can start to build every month what you think your projections are going to look like. Make sure that you always know about the price, the costs, the break even, and then the expected profit. The judges are going to ask you, where did you come up with your selling price? Make sure you have a compelling argument to show that your selling price is realistic, it's something that the customer is going to be willing to pay, and that you did your research to think about what makes the most sense for your selling price. For your costs, the judges are going to say, okay, if you think your variable cost is $1 per unit, how did you arrive at that number? Right? So you have to be able to say, okay, well, my variable costs are bottling costs. I have material costs. So you can explain to them exactly where those numbers come from. Fixed costs, so you can say I have rent, I have a salary that I'm paying somebody a fixed amount every month. So those are also costs that you can explain. Okay? Future potential. In the beginning, typically companies lose money, but over time they're going to be making more money, right? So for the future, think about my sales are a certain amount. How much are they going to grow every month, right? So when you figure out your income statement for the future, you can figure out, what my selling price, variable cost, and fixed costs are, and then each month you can assume that they're going to start to go up, right? And you can build that into your model. Yes.
So then we should divide the initial costs versus kind of like the future upkeeping costs, because in the beginning.
Right. Exactly. So when you figure everything out in the beginning, it should just be your initial costs, and then periodically you're going to update everything and redo all of your analysis, right? Because you might change your selling price in the future. Maybe your variable costs went down. Maybe you bought a bigger location and your fixed costs have gone up. Right? All right. So those are the concepts that I want to present with you today. And then here's my email address. So if you have any questions, you can email me or stop by. If you look at the last page in the handout that you have in front of you, I want you to do an activity now, and I'll come around the room and help you. I want you to think about 5 different things. For your business, think about what your variable costs are going to be. So I'd like for you to make a list of what your variable costs are, and then add up that total. In step 2, think about what your fixed costs are going to be, and then add up the total. And then in space 3, can you tell there's a little bit more space? Not a whole lot more, but there's a little bit more. So in step 3, think about what your selling price is going to be. And give me a short explanation as to why you chose that selling price. Okay? With all that information, you can do step 4, which is to figure out what your break-even is going to be. Okay, so your break-even units. And how many units are you expecting to sell? Okay. Everything that you do here should be listed out, and you should have an explanation for why you think the selling price should be $49.99. Right? Or why is the variable cost $4 per unit? All right, so I'll let you work on this, and then I can come around and then help you with any questions. And when we close, I would like people to tell us what their break-even is going to be. And we can go around the room, and you can tell us how many units do you have to sell to break even.
All right. Thank you very much.
All right.